Michael Burry may have found the perfect AI short. Real technology, real demand, and valuations that have run too far, too fast. Real technology, not vaporware, not a scam. Real demand, companies are using it, paying for it, expanding it, and valuations that by every classic metric have gone too far, too fast. That's the setup. And if you're watching this, you're about to find out why it's also the most dangerous short of Burry's career. If you've read The Big Short, you know this part. Michael Burry was a neurology resident who taught himself finance, started a hedge fund in his living room, and in 2008 became the man who saw the subprime collapse coming, while every major bank on Wall Street cheered the other direction. He read thousands of mortgage bonds, page by page, loan by loan, and he bet against all of them. Scion Asset Management made $100 million for Burry personally and $700 million for his investors. Michael Lewis wrote a book about it. Hollywood made a movie. Christian Bale played Burry. That was 18 years ago, and since then, the financial world has treated every single Burry warning like a prophecy. Because he was right once, catastrophically, famously right, and now he's doing it again. June 30th, 2026. Substack post, trading post. Michael Burry laid out positions that, if you're long any AI stock, should make you pause. Nvidia, Tesla, Micron, Applied Materials, Caterpillar, the iShares Semiconductor ETF, SOXX, and Palantir. Put options, massive size. When the 13F filing hit, the number was staggering. Roughly $11.1 billion in notional value, representing approximately 80% of his fund's portfolio. This is not a trade. This is a declaration of war against the entire AI sector. And the positioning makes sense. Nvidia is the single most important AI stock on the planet. Tesla is the AI-powered EV bet. Micron makes the memory that feeds the AI beasts. Applied Materials makes the equipment that builds the chips. Caterpillar is the AI infrastructure play. Power systems for data centers. SOXX is the whole semiconductor sector in one ticker. Palantir is the enterprise AI play. Burry isn't picking one stock, he's shorting the thesis. And then came the follow-through. On July 1st, he doubled down on Micron specifically, shorting shares at $1,051.87. The stock had already rallied nearly 700% from its pandemic lows. Burry called it AI bubble territory. His words, Micron defines cyclical like no other. And on July 3rd, when Elon Musk tweeted that AI would fund universal basic income and working would be optional, Burry fired back 4 words. False. There will be revolution first. A blunt warning, a 4-word prophecy. And here's the thing, if you're long AI, you should take this seriously. Not because Burry is always right, but because his thesis is coherent, his data is real, and his conviction is absolute. So let's look at what he's actually saying. Burry's argument has 5 pillars, and I'm going to state each one fairly, the way Burry would want you to hear it. Pillar 1, valuation. The Philadelphia Semiconductor Index, SOXX, is trading roughly 65% above its 200-day moving average. We last saw levels like this near the dot-com peak in 2000. Micron's deviation from its own historical mean is the highest it's been since 1984. These are stretches, real stretches, and in the past, when semis stretched this far, they snapped back. Pillar 2, cyclicality. Micron has suffered 34 drawdowns of more than 30% over the past 42 years. Its median return on invested capital, around 4%. Return on equity, about 7%. Its history is a graveyard of boom-bust cycles, and Burry believes this time is no different. Pillar 3, consumer unwillingness. Burry has stated publicly that consumers have shown no willingness to be significant sources of revenue for AI products. People use ChatGPT for free. They use free tiers. The money, he argues, isn't coming from the end user. It's coming from enterprises whose own ROI is unproven. They use free tiers. The money, he argues, isn't coming from the end user. It's coming from enterprises whose own ROI is unproven. This is his core historical argument. In 2000, the internet was real. The technology was transformative, and Cisco, the biggest name in networking, was valued at 200 times earnings. Why? Because investors believed internet demand was infinite, so Cisco built capacity for that infinite demand. But the demand wasn't infinite yet. Broadband was rare, e-commerce was primitive, mobile apps didn't exist. The restaurant was built, and the customers didn't come. Cisco's stock fell 89% from its peak. It took 15 years to retouch that 2000 high. Burry says AI in 2026 is Cisco in 2000. Real technology, real demand, valuations that have run too far, too fast. GPUs lose value fast. A chip bought today might be outdated in 3 years and fully depreciated on the books in 5. Burry argues that the massive capex pouring into data centers may never deliver proportional returns because the hardware is depreciating faster than the revenue it generates. Now, here's where I need to be honest with you. Everything I just told you, that was Burry's case, and it's good. Not good enough, but good. The valuation stretch is real. Micron's history is genuinely ugly. The dot-com parallel is instructive, not just nostalgic. And if you ran these 5 pillars past any portfolio manager who lived through 2001, they'd nod slowly and say, "Yeah, this time it's different," is the most expensive phrase in investing. So I need to earn the next part, because if you stop watching now, you'll think I'm another tech bro telling you AI is bulletproof. It's not bulletproof, it's something more dangerous. It's actually working. The problem with Burry's thesis isn't the data. The data is correct. The problem is the interpretation. Every single data point Burry cites is a data point from the last bubble. And when this bubble is different, when the demand is real and here now, the same data points mean something completely different. Valuation stretch doesn't matter if revenue is compounding at 1000%. Cyclical history doesn't matter if you're in a supercycle with 4 consecutive waves of demand. The dot-com parallel doesn't hold because the customers are already inside the restaurant, and depreciation doesn't matter if the hardware is paying for itself in 18 months. Burry is reading the right footnotes. He's just reading them in the wrong chapter. Let me prove it. Burry's favorite analogy is Cisco in 2000. Build a big restaurant and nobody comes. It's a great analogy. It's also wrong for 2026. Here's how you know. When a restaurant is overbuilt and demand is absent, the price of the food goes to zero. No customers equals no revenue equals prices collapse. So let's look at what happened to AI's food prices, the rental rates for GPUs. In October 2025, an H100 GPU rented for over $7 per hour. That was a supply-constrained peak, the highest the market had ever seen. By March 2026, that price had fallen to $2.35 per hour. Now, if Burry were right, if demand were illusory and the restaurant were empty, that price would have collapsed further. It would have gone to $1, then 50 cents, then 0. But it didn't. It stabilized at $2.35. And here's why that number is so devastating to Burry's thesis. At $2.35 per hour, an H100 generates roughly $50 in revenue per day. That's $1,500 a month. That's $18, $80,000. At hardware costs roughly $25,000 to $30,000. At $50.35 per hour, you're paying off the GPU in under 2 years. Even after electricity and cooling costs, the payback period is breathtaking. That's not a dead restaurant. That's a profitable business getting more efficient as supply catches up. But it gets better. Google, a company that designs its own AI chips and has massive internal capacity, is paying OpenAI $900 million or more to lease compute. They're renting because they can't build fast enough. Anthropic is paying Google $12 billion for 100,000 custom chips, not buying, renting, because they can't source capacity any other way. In 2000, nobody was paying Cisco a dime to reserve router capacity. The restaurant was empty. In 2026, the restaurant is full, and the customers are prepaying for their tables. Burry says the fiber optic parallel proves him right, but the fiber optic story proves the opposite. When demand is real, the price floor holds. When demand isn't real, prices go to zero. $2.35 an hour isn't zero, it's confirmation. Now, let's talk about the number that should keep Burry up at night. Token usage. If you want to measure the occupancy rate of AI, the real physical usage of the infrastructure being built, you track tokens. Every question asked, every document processed, every code generation, every image created, it all runs through tokens. So let me give you three numbers. In 2024, Google's AI infrastructure processed 97,000 trillion tokens. In 2025, that number was 480,000 trillion. And today, in mid-2026, 32 million trillion tokens. That's not a typo, 32 million trillion. From 97,000 trillion to 32 million trillion in 2 years. That's a 330-fold increase. If this were office buildings, it would be as if a landlord had 100 tenants one year and 33,000 the next. If someone then said, "I think the office market is overbuilt," the response would be, "The building is at capacity, the new building is at capacity, and there's a waiting list." Microsoft Azure, the second largest cloud provider, processes 100 trillion tokens per quarter. Amazon Web Services is first, Google is third. Year-over-year growth, 5 times. Monthly records, 50 trillion tokens in a single month. 300 customers, each processing more than 1 trillion tokens annually. This is not trial usage. This is not "we'll see." This is not the cautious enterprise experimentation phase. This is the fastest infrastructure to demand ramp in the history of technology. And if Burry is right that AI is a bubble, then the bubble is demanding 330 times more capacity in 2 years than anyone thought possible. But wait, Burry's strongest point is consumers won't pay. People use free tiers. The revenue isn't there. Let's check. In February 2026, OpenAI's annualized revenue run rate hit $250 billion. That was 5 months ago. Today, analysts estimate $400 billion to $500 billion annualized. For context, most companies take decades to reach $1,300 billion in revenue. OpenAI, a 5-year-old company, may hit $500 billion this year. Anthropic, also 5 years old, hit $470 billion in annualized revenue in May. That's faster than Google, faster than Amazon, faster than Walmart, faster than every company in the history of capitalism. Burry says consumers won't pay, but the evidence says they're paying, and paying more every quarter. His argument isn't wrong because he misunderstood the tech. It's wrong because he underestimated the willingness to pay. The same way he underestimated Tesla's customers, the same way he underestimated Amazon's customers, the same way every cyclical thinker underestimates what happens when a product becomes infrastructure. And now we get to the deepest flaw in Burry's thesis. He thinks AI is a cycle. He compares it to memory chips in 2021 to 2023. Demand spikes during COVID, stocks soar. Demand normalizes, stocks crash, a cycle. But memory chips were a cycle because there was only one wave. Demand came, demand went, done. AI is not a single wave. Wave 1, training. The foundation models, GPT-3, GPT-4, Claude. Massive compute to build the models, done. But when training plateaued, something else was happening underneath. Wave 2, inference. Millions of people and enterprises start using the models. Every query is a token. Every token is demand. Explosion, 330 times in 2 years. And just as inference demand starts to mature, wave 3, agentic. AI that doesn't just answer, it does. Writes code, runs tests, debugs, produces reports. One instruction from a human triggers hundreds of steps from the AI. A single task that used to be 1 token is now 1,000 tokens. And wave 4? Physical, robotics, autonomous vehicles. Every robot with a brain. Every endpoint making real-time decisions. Each one a permanent token consumer. Burry is thinking in 3 dimensions. A supercycle requires thinking in 6. This is not boom, then bust. This is boom, then bigger boom, then bigger boom, then bigger boom. So let's go back to our opening. Michael Burry may have found the perfect AI short: real technology, real demand, and valuations that have run too far, too fast. He's right about the technology. He's right about the demand. He might even be right about the valuations being stretched, but he's wrong about the conclusion, because when real demand meets real technology at stretched valuations, you don't always get a crash. Sometimes you get the beginning of something bigger than the models predicted. The big short investor made his famous call by reading what others wouldn't. This time he's asking the right question: will the money come back? And running the right data. But the data isn't saying what he thinks it's saying. The restaurant isn't empty. The customers are inside, and they're ordering seconds. The revolution isn't coming first. The revolution is already here.